I've had the privilege of working closely with her and the broader Marathon Capital team during that time. She's provided valuable feedback on our products and insights into the market and has played a key role in helping us better support Marathon's needs and, by extension, the needs of the broader energy community. In a minute here, I'll hand over the microphone to Joan. She'll walk us through an overview of capture rates and some examples of how she uses them in her work. During her presentation, feel free to write in your questions. We'll be reserving some time at the end to walk through them. To start, she and I will provide some brief background on REsurety and Marathon Capital to help give a better sense of our fits in the energy community. Starting with REsurety, REsurety is a solutions provider that serves the financial and sustainability needs of the clean energy industry. Our core customers today are clean energy buyers, developers, and investors. We bring together in-house expertise in renewable energy and atmospheric science, power markets, and data science, all through a blend of transaction services and advisory, as well as data and software solutions. REsurety's software platform provides our customers with insights along different stages of the clean energy development, investment, and procurement life cycles. The Project Explorer supports customers in their initial prospecting and market discovery, helping them evaluate renewable value and emissions trends across U.S. markets with our mix of historical data and fundamental forecasts. The Project Evaluator provides customers with contract-specific valuations and emissions impacts during RFPs and bilateral negotiations. And finally, the Portfolio Tracker supports investors and energy buyers after their investments or contracts are signed, helping them consolidate ongoing performance tracking and forecasting of their entire portfolios in one place. With that, Joan, I'll hand it over to you and you provide a brief background on Marathon Capital.
Yeah, thank you, Blair. It's a pleasure to be here. So Marathon Capital is a boutique investment bank, and what we focus in on is renewable energy, renewable fuels in general, and sustainable technologies. We've been in the industry with starting out with wind solar focus since 1999, so celebrating 25 years in this space. And we've grown. I think that might be something that's new to parties that know Marathon from the past. We've grown globally and certainly added additional areas of expertise. We have over 50 senior bankers at this point. If we go to the next slide, you can see the categories where we focus our expertise. So it's clean energy, distributed generation specifically, low carbon molecules, and then the sustainable technologies. For today, really what we're talking about is our core of solar and wind analysis, and coming at it more from the offtake perspective, but of course, always looking at it from what is the value to the developer, what is the value to the offtaker, and how can we make transactions smart as we do our negotiations. And by smart, I think it's important that we do understand the value of the product that's being bought and sold and the requirements for financing. So that's what's unique about Marathon, is bringing the offtake advisory practice inside of an investment bank. If you go to the next slide, you'll see the global presence, and that's more for interest. I think, anywhere where you have VPPA settlements or contract settlements, swap settlements, it's of interest to buyers to understand the product that we're talking about here, the capture rate product. So with that, we have quite a large audience here. And so I'm assuming we have parties that are, very familiar with the concept and some that it's new to. So we're going to start at the beginning with just discussing what capture rates are and why they're important. And then we'll move into some of the definitions and then into how they can be useful. So let's go to the first slide on the overview of capture rates. So capture rates are used to calculate the realized price that a project will either receive if they're selling into the market or will settle against if you're settling a VPPA. So from a buyer's perspective, you're thinking about it from the settlement perspective. As a developer, you're looking at it from both perspectives. And why would you use this approach? It's when you have forward price information that's not specific to your project. If you have that information from an independent evaluator that is telling you exactly what the forecast price is for your project, then you may use the concept of a capture rate to run scenarios around that. but your primary base case would be based on that, on the report that's generated by an independent party for your project specifically. So capture rates are specific to each project, and that's because each project has their own generation profile. And what this means for solar is that you're more able to borrow information from other projects because there's less variation with solar generation. And what it means for wind is you have to be very careful if you're borrowing information from other projects. Capture rates are different for each time period. So if you were to look at information for a monthly or annual basis, you will find the capture rate calculation gives you a different number. And capture rates are also very hard to predict. There's a lot of factors that go into what would your capture rate be for a project over time. However, historic information that's available, and we pull this from REsurety, historical information can give you some clues for what you want to predict for your future capture rates. And it can be very useful in developing that intuition as to what affects capture rates, and that you can observe trends through looking at historic data. So having historic data available to consider capture rate analysis is, we find, incredibly useful and supports a lot of our analysis prior to getting a final bankable report that would likely be used through financing. So it's a tool that developers use to estimate the value of their production, the revenue that they'll put in their financial model. And then it's used by buyers to forecast their expected settlements in VPPAs. And I would add to that point that it's not just the expected that people are interested in. You obviously also want to think about scenarios and what variables can change your base case expected value. So we can move to the next slide. That's just to warm us up to get thinking about why you should be interested in capture rates. And thank you for being interested anyways and showing up today. But let's start with what is the generation weighted price, because this is what the basis of capture rate is. So an average price, all familiar, you just take every hour that you're interested in and weight those hours equally, or literally they're unweighted, and you create a simple average. But looking at this example of solar generation weighted price, you notice that solar only generates in certain hours. And so if you're weighting the hourly price by the generation, you would have a zero weight at the beginning of the day when it's dark out and at the end of the day. However, during the middle of the day, you would have very high weighting on those prices. And so when you calculate the solar weighted price, you find that you get a higher price in this example than the average. So the solar hours are capturing that incredibly high spike in hour 16 through 18, and they're capturing some of that second bump on the end as the solar declines in volume. But because you're not averaging in all those low hours, you end up with a solar weighted price of almost 500 and a simple average weighted price of 300. This is obviously a pretty spicy day in Austin, Texas. This is not what you should be expecting pricing to be for solar on an everyday basis. But that highlights what the difference can be between generation weighted price and your average price. So moving to the next slide is the definition of capture rate. And a capture rate is really exactly that same information, but provided in the form of a percent. So you take your solar weighted price and divide it by the simple average. And that tells you what percent of average did you receive for the value of your solar output. In this case, you received over 100%. You received 167%, meaning that you got above average pricing relative to the average for the day. So solar or capture rates can vary. They can be above 100%, below 100%. I've never seen it, but you can also, I imagine mathematically, you could also have a negative capture rate if your project was generating only during negative price hours. So what this tells you is it gives you information that's a little bit more generalized. So instead of somebody saying, oh, I got $500 for my solar project, now you have a capture rate. And if tomorrow somebody told you that the expected average price was going to be $100, you could use that information and project, well, maybe my solar project is going to capture 167% of that value, and my expected solar revenue 100 times 167, I'm expecting $167 tomorrow. So it just translates very specific information into something that's generic that you can then use and play around with a bit. So in the next slide, you can see that what the math that I just did on 100 times 167. So you can see what realized prices are and compare from the around the clock value, the average price at the top, to a solar realized price or a wind realized price. So if somebody gives you, and this is pulled from REsurety's product, but if somebody were to give you the around the clock price and you knew the capture rate, what you would really be able to do is calculate all these realized prices. On this slide, what you can see is that, if you take California, for example, and you look at the solar realized price, it's lower than the average price, and yet wind is higher than the average price. Similarly, in Texas, you can see that in that case, solar is higher than the average price, wind is lower than the average price. So it's also useful for just generally getting familiar with the markets and the relative value of solar and wind in different markets. One concept that we've captured at the bottom here is negative correlation. So when you see that the increase in volume of wind is tied to an average lower price, that's directionally opposite, more wind, lower price. So you have a negative correlation there. And this is one of the elements that we look quite hard at when we're looking at information about capture rate and capture rate trends, is as we see forecasted increases in wind and solar penetration, are we seeing that negative correlation where there's sufficient impact to pricing that the capture rates are reducing? So a negative correlation will manifest itself in a reduced capture rate, basically just meaning the more solar you put on the system, the lower price solar gets, the more wind you put on, similarly, the lower price wind gets. But that's a phrase that you'll hear, negative correlation. So let's go to the next slide. Just wanted to include this to show, and it's a lot of lines there. But if you look at the dotted lines, that is wind and solar generation. And then you see a shadow of gray, that's the load. When you're looking at the black line, you're seeing the price at West Hub in this example, and then the yellow and blue lines show you the price that the solar and wind projects achieved at their interconnection point. The main aspect here to think about is that it's not, we talked about negative correlation and how the volume of wind and solar can change price. You also have to think about how the load shape can change price. So as you think about scenarios over time, thinking about load growth, thinking about wind and solar penetration, and thinking about time of day, generation, time of day, load use, all factor in. And in this example, you can see how price changes with both load and generation. So in the middle of the day, when you have higher generation coming from solar with still some wind contributing, you see prices really drop. And then as you see solar coming off and load still high, it's the intersection of those 2 points that causes price to go up, even though wind is trying hard to keep pace with the increase there. So it's a reminder that when we're thinking about capture rates and what affect capture rates, sometimes the impact of load can be important to take into account as well.
And I think what I like about this slide too, Joan, when I think of this in conjunction with the first slide you showed with the typical solar capture rate, or what might have been, is you're kind of showing a real evolution in how solar capture rates are changing and what's influencing solar capture rates. You know, in the prior chart, what you were looking at, solar was capturing a fair amount of value, but in here you'd start to see that it would be capturing a little bit different value and slightly less, because now price strength and pricing extremes are happening at a different time of day.
Yeah, exactly. And we saw that most prevalently in California, where you'd have to roll the clock back a bit now, but at one point, the capture rate for solar was, say, 140%. And then it crossed over to parity, 100%. And now we're at a level where solar attracts far less than 100%. And that's because of the abundance of solar in the middle of the day, and then the dearth of resources at the morning and evening ramp. So as load increases in the morning and decreases at night, it's very costly to meet that load, but solar's not getting those high prices. And so the curve is twisted away from the solar hours to create value in the shoulder hours, and left solar capturing far less than 100% of the average price. So we can go to the next slide. We've got examples in PJM and in MISO. And so when we think about the trends in capture rates, so we're looking here at the dotted line is pulled from REsurety. So the trend in capture rate, and then you look at what we're forecasting for an around the clock value. When you marry those two things up, you find that the generated weighted average is diverging, right? This is an example of although prices are continuing to be forecasted to go up, the value that you're getting for solar, it's still going up, but not quite as fast as that average price. So in this case, if you had your own assessment of around the clock value, but you didn't have a specific solar value, you could look to REsurety's product to borrow the capture rate here and take that value, multiply it times your forward curve, and give yourself a better estimate of what to expect for the value of solar at this location. When you look at MISO, on the other hand, the capture rate kind of bumbles around. It doesn't drop as precipitously as you see in PJM, and therefore you're actually getting fairly close value for your solar to that average capture rate, and certainly the trend lines are really right on top of each other. So you can't borrow a PJM West capture rate, apply it to MISO Illinois. You have to think about each market specifically, each resource specifically. And you'll see in the next slide a similar set of examples for wind, where we see in SPP North, there's just been a consistent lower value for wind. And in Cal ISO, wind has been pretty much right on top of the value, the average value. So we can look at the next slide. And this is just to show that, sometimes we get in the habit of using approximations, right? So when we're thinking of wind is often generating at, solar is a little bit more consistent. People often will look at solar and say, well, I could estimate my solar value is going to be based on the on-peak price, because solar is more of a non-peak product. Even that's not a great idea. But with wind, because nobody knows when wind's going to blow, and it tends to vary quite a bit, historically people had said, well, 5 days out of 7 are on peak, 2 days out of 7 are off peak. We're roughly when you look at the average energy production from wind, you end up with about 5/7 of it being in on peak and 2/7 being in off peak. So they just weight it with that rough estimate. However, when you look at a more sophisticated look at like a fundamental evaluation of how price will be forecast, and then properly marry that with the input wind assumptions, you find that the valuation you get is quite different. 5/7, 2/7 is overestimating relative to what a fundamental analysis would give you. And, this type of deviation in estimation is very important, because at some point, I'm thinking of it from the developer's point of view, at some point you're going to get an IE report that is probably going to align a lot more closely with your REsurety value than your approximated value. I think most parties have moved towards more sophisticated valuation, but it's a reminder that investing in the next level of thinking, and even the next level and the next level, is worthwhile. Some of the tools that are available are really, quite useful and make a difference to your ability to continue on with decision making, feeling like you have confidence in the approximations you've had to make along the way. And, similarly, if you're a buyer, if you were thinking, the settlement for the production of wind is going to be quite high, only to find out that that was based on an assumption that's not really the most sophisticated assumption that you could make easily, you may be estimating the value of your settlements under a VPPA. In this case, it would be in too generous of a way. If it had been the other way around, good surprises are good. But I think in either case, you want to be fairly well grounded in your estimates. And certainly capture rate is something that is a useful tool for making estimates. And you can dig into it, in deeper and deeper ways. We can go to the next slide. So we often look at the historical pricing and capture rate, and you can do this also for basis and curtailment. In the absence of a very expensive forward-looking analysis by a third party, using historical analysis gives you a sense of what to worry about and a sense of what to expect. And so I always say that using these tools, the first thing it's going to give you is it's going to improve your intuition. So thinking about, well, why did the capture rate change over time? What has happened in these various years where you may have seen a trend? How can I use that to then anticipate the future? How can I take a recent capture rate, apply it to the future in an intelligent, well-founded way? So when we don't have project-specific forward, pricing provided, with somebody doing a robust fundamental analysis, we can use capture rates. And as a reminder, of course, you have to be careful which capture rates you're borrowing, because you're usually looking at a project location where there is no project, because that's where you're about to build your project, or if you're a buyer, where you're about to contract for a project. So you can think about the location if there's an operating project, or if you're using REsurety's product where there's historical data available even when there isn't an operating project. You want to think about the location and the generation to marry up what you're borrowing from the historical analysis to apply to your new project. You can also think about trends over time. So you can think about what wind or solar generation is forecasted to be built in that area, and how do you think that that's going to affect the capture rate over time. And you can also think about how would storage maybe mitigate any trends that you're seeing because of that. One of the things we haven't been including here, and you can include with a capture rate analysis, but you have to be cognizant of what you're doing, is you can use capture rates at the hub or at the node. And so if you're using a capture rate at the hub to estimate your capture rate at the node, you have to realize that you've now embedded basis inside that. And that's okay to do mathematically, but you just have to be aware that what you're estimating now has two components to it. It has that what percent of price are you obtaining, as well as what cost did you have to incur through your basis. The basis being the difference in price between the node and the hub. So as long as you're thoughtful about it, a capture rate analysis can blend the two. Alternatively, you can stay sort of pure to the forward pricing at the hub, get your capture rate, and then think about how to apply basis separately. But if you're thinking, I find the historic analysis, looking at the trends, picking some, getting your thesis on what to think about for the future also prepares you very well if you are going to do a more costly analysis through a third party, because now you know what scenarios you want someone to run. Now you know where you think the problem areas are that you want to do a deeper dive in. And you have to make decisions over time prior to having your final bankable report. So you want to have the best tools available. Using this capture rate analysis is one way to start to play around with the data and get that. I'm going to turn to the next slide where we just show the example here of a MISO hub solar project. And you can see it's a slight trend. I have to squint a little, but you can see that at the end of February, the capture rate was just over 109, almost 110%. But when we then roll into a forward forecast, also provided by REsurety in this case, you can see that the rate ends up, that's in August 31, at almost 104%. So if you had simply taken the last number at 110, you probably have overestimated going into the future. If you draw a trend line, you might have found that you get a little closer. So just an example to show that, the past is useful, but you have to think about how to use it into the future. Are you using an absolute number or are you using a trend line?
And I think where a lot of your expertise comes into play, Joan, is knowing what markets and what parts of markets you should and shouldn't be applying that assumption going forward, because obviously how quickly things are changing in the energy landscape, it can make a big difference in how much you rely on historical versus forecasted data and knowing when to use one over the other.
Right. Also, temporal analysis becomes really important because you have to be thoughtful about, applying too much precision and knowing when to pull back. And, normally I would say averages are your enemy in renewable energy because you blur out the really important information. Like you can blur out negative pricing when you're using averages. However, capture rates are one where you need to be thoughtful about, are you going to become too precise, or is it a better tool to use for broad strokes? So do you pull back out and use bigger chunks of time, bigger chunks of data to get those trends? It is. I know this sounds like I spend a lot of time thinking about things in detail, which I do. This is the problem with the REsurety tool, is that I get so into the weeds and finding all sorts of interesting things. It keeps me up at night. But it is interesting also to zoom in a little bit and see, well, has my capture rate changed? Because, especially ERCOT, where everything exciting happens in the summer, except for February sometimes. It is interesting to see whether the trend is only impacting your summer revenue. Has the capture rate been exactly the same for every other month except for the handful or 3 summer months? Because if only the summer months are changing, that's really useful information. It's also where the greatest volume of your solar power is going to be generated. It's also something that you can think about when you're doing VPPAs, like how do you share risk, protect against risk? How do you evaluate that? So it can be interesting to do a bit of a deeper dive once you figure out what's affecting your value.
And I know from a timing perspective, there's a lot to think about, but one of your slides here also showed the importance from a location perspective, which you mentioned. You could have the generation well timed, but if it's occurring at a node that's getting priced down relative to a hub, then you're introducing this basis risk that you have to in some way account for.
Yeah, exactly. So, yeah, super useful tool. Best if you have a little bit of background and know how to sort out where it can be applied with the most confidence. But certainly pulling historic data, playing with it, running scenarios, which we can turn to the next slide. These are fairly basic scenarios, but just wanted to make the point that if you have a base case of your forward pricing, so it's around the clock or you get on off peak, whatever your data is. And then you have a capture rate. In this case, the capture rate came out at 95% in our scenario. You can then start to play around and say, well, what if just playing around with the around the clock value? Keep the capture rate the same. Assume that the past is a good forecast for the future. What happens if that forward price changes by 10, 20%? How much does that affect the value? And you could think, well, why would the forward price go up or down? Is that the price of gas? Is it, what other influence could be there? And do you care about that scenario? If you go to the next slide, you can then say, well, what if I really believe my forward price curve that I'm using is pretty solid, been well thought about, but I am worried that this on-off peak price, just like California, example we talked about earlier, maybe my capture rate gets better or worse. Maybe I think there's going to be a lot of storage come in, and I think that's actually going to net benefit me. And I think I'd like to be optimistic and think I could be getting 105%. Or maybe you look at the generation that's scheduled to be built in and around where your project is, and you think, wow, even if half of that gets built, I think that's really going to knock down my capture rate. I'd like to look at, in this case, we just did it flat across the whole curve. You might want to start at your 95% and then tick it down over years. But, what if it was just lower? So this is a couple of basic examples, and then you could combine them and say, what if my pricing went up, but I got a lower percent of that pricing, and there's 4 combinations there. So these are some just really basic analysis, but you can start to layer in a little bit more. And like I said, you want to build some intuition. You want to understand the order of magnitude of the possible change. And then ultimately, when you do your final analysis, you may need to invest in something that's very project specific to get that analysis. But now you know what you're thinking about, what you're worried about. You have that intuition. If you get an odd result, and honestly, as much as I love our IEs, every once in a while there'll be something, and it's because maybe it's a transmission assumption that they made that you weren't aware of. But if you don't even know to ask the question of like, wow, that's different than I expected, you'll never get those answers. They'll just be buried deep inside the analysis. So, we spend a lot of time trying to quickly get a sense of project dynamics, impacts, looking at it in broad strokes, getting a little bit more refined. And I think it sets us up very well and our clients and I was going to say, we do it for our clients. Sometimes I do it just for fun, but usually I'm supposed to be doing this for a client. And I think it sets us up very well for, for where there's risk and where there's benefit in projects. And if you're a buyer, for understanding, where you may see settlements that are out of the range of what you expected and why that would happen. I think that's the important part, not just, prices could be anything. It's like, if this happens, you might see this impact to your settlements. So no one likes surprises. We try to minimize them.
I think I like the way that you framed this slide and kind of summarized it, Joan, because you're connecting, I think, what can be some complicated items like fundamental inputs into the market, gas prices, supply build out, load growth, but at their core, how are they impacting these principles? And then what do I need to know intuitively about how these principles might impact me from a settlement or value perspective? Because that's where you can spend a lot of your time, is digging into the complexity of market dynamics and fundamentals. But if you have some anchor to how they influence the value that you're looking for, then you can have an easier time of navigating. Yeah, I like the way that you've presented this.
Great. And I think that's the end of the slides. And so certainly happy to have discussion or questions. I know some of the parties on this call are have a deep understanding of how to analyze markets. So, comments are welcome as well as questions.
Perfect. I think we've actually got a few come in while you were speaking. I think the first one seems to be geared towards obviously we're talking a lot about energy prices and the things that can influence energy prices and generation weighted value. But what kind of relationship or impacts do you see between energy prices and the PPA market or PPA prices and value?
Yeah, I think if you're looking at it from a developer, and my background is energy trading, renewable energy development, and now banking. When you're looking at it from a developer perspective, you're really trying to create a revenue stream that supports your project. So you have your input costs, you have your financing assumptions, and your operating costs that you're predicting. And then you also, the way the market affects you most is if you are taking on any basis risk and you're settling at a hub. So you have that risk, and that is a market price difference between your node and the hub. And so that's the market that you're worried about. And that's it's tied to everything, I guess. It's tied to load growth and renewables growth and transmission build out. So that is the area where the markets affect the developer the most. They have to take, well, actually there's two areas. They have to take a view on that. And then the second really incredibly important element, and it's super hard to do, is you have to have a view on what happens after the contracted period, which is probably say 15 years from now. So you need a pretty good crystal ball out there. But the developers goal is to get their returns that are required and to get the interest from financing parties and to get the debt that they need to pull this all together. And if you said to a developer, look, your PPA is going to be $50 and it meets all their return requirements, and you tell them that the market is 75, they might not care because they can't get it financed without having a fixed price contract, without having knowable revenues. So it's not incredibly tied to the market price. Where it's incredibly tied to the market price is when you think about the buyer who is entering into a VPPA, because they have that price risk. They're really doing a swap, a fixed for floating swap. So it's the difference between your fixed price and the market price that as a buyer, you're either paying against or getting paid against. And so you don't know what you're going to settle until you know that forward, until you are in the time period where you're settling, but you want to forecast that. And so if you're forecasting that your VPPA price is going to be $50, but the market's going to give you 75, well, you're making presumably $25, 50, 70, yeah, $25. Whereas if somebody said, well, prices are really going down, you're probably going to be settling against a $30 contract. Now you're paying $20 to get that REC that you need. And that's a big price for a REC. So it really affects the buyer quite a bit. And the seller will look at that market price and think, maybe I can contract only 70% of my project and keep 30% merchant, get some of that upside. Or if they're the only game in town and there's no competing resources and there's a whole bunch of buyers, they might try to push that price up and get even more than their minimum return rate. But I'd say in my time in this part of the industry, it's been pretty hard for project developers to really, sort of grab at all that value, because generally there's competition. Generally, developers are doing their very best to keep costs down, be reasonable in the price that they need. And we won't get into it here because it's another whole topic, but the changes in how tax credits are monetized are giving developers a little bit more freedom.
Thanks for that, Joan. Maybe time for one more question, and tell you what, I'll give you a choice here between two. So one question, I think just around the general influences on capture rates, what might cause them to increase or decrease for wind or solar. Second one, maybe a bit meatier. So we've talked about solar and wind capture rates. How should battery storage assets start to think about this, or do they have to think about it differently?
Yeah, that I was thinking about that storage question as I was putting this together and decided to punt on it because it is a lot. And I don't know if capture rate is, I mean, because
Right.
you've got both the buy side and the sell side. But I think you'd probably have to think about it quite differently though. And then on solar and wind, I think the biggest impact on capture rate has been the development of other solar and wind projects. So the penetration of solar and wind has been the dominant factor.
So I think in the slides that you were showing us earlier, you had kind of the first one, which was maybe solar in Texas 5 years ago, where the timing of the energy is well timed with pricing strength. And then you have, I think, later slides that start to show pricing strength happening later in the afternoon. And one of the things that happened then is that a lot of solar got built in Texas. And so it started to change its own capture value.
Yeah, people are definitely chasing that. And we've seen portfolios, like really thoughtful developers saying, you know what, pick Arizona. It's a great solar resource. Everyone's building solar. I'm going to build wind. The wind's not great, but guess what? The wind's going to get all that price that solar isn't cannibalizing. So you can have kind of that contrarian view. Developers used to just, when I was in development, we used to think mostly about resource. If we have a good resource, we're going to have a good project. That's just not true anymore. You have to have a good revenue stream. And so even a fair project from a resource perspective can have a better revenue stream.
Well, Joan, I appreciate your time. I think if there's any questions that we didn't get to, I can see if I can follow up with some folks offline to get the answers that they need. Also appreciate all the effort that you and the rest of the team put into this presentation leading up to it, Joan. Any last words for folks as they go out and try and think of this on their own?
Oh, it's really quite fun. You'll get right into it, I'm sure. But if you do have questions, yeah, reach out to REsurety. I'm happy to follow up as well. And really appreciate you all joining today. Thank you.
Likewise. Thank you, Joan. We'll follow up with links to the recording and slides afterwards. Thanks, everyone.